Netflix just posted its best revenue quarter in its history. Operating margin, a record 33%. And Wall Street's response was to cut one price target after another. The stock fell 12% to its cheapest valuation in 4 years. So either the market knows something we don't, or it just made a mistake. So let's answer the question everyone's typing into the search bar right now. Why did Netflix stock crash? And is Netflix stock still a buy after earnings? Here's the setup. On July 16th, right after its second quarter results, Netflix fell about 12% in a single day. It now trades at a price-to-earnings ratio of roughly 21.7, the lowest it's been in 4 years. Not since the 2022 bear market has the stock been pushed down this far, which brings us to the question in the title. Netflix, are you really okay? Did the business actually break, or did the market just get scared? Let's take it apart, piece by piece. First, was the quarter actually bad? Open the numbers, and it's the opposite. Revenue came in around $12.56 billion, up 13% from a year ago, and the highest quarterly revenue in the company's history. Earnings were 80 cents a share, and as I said in the open, operating margin hit 33%, a record. On the numbers alone, there's nothing to be scared of. It's a strong report. So why the 12% drop? The trigger wasn't the quarter. It was two things. First, the guidance came in light. Netflix's forecast for the third quarter was about $12.86 billion in revenue, growth of 11.7%. Wall Street was looking for closer to 13%, or roughly $13 billion. That small gap, the signal that growth is slowing, is what spooked the market. Second, Netflix said it would cut back a disclosure called the What We Watched report. That's the report where every 6 months, the company revealed how many hours people spent on each title. Starting in 2027, that moves to just once a year, and the market read it in one way. If growth is slowing, are they trying to hide it? So here's the starting point. This crash didn't come from bad numbers. It came from shaken expectations and shaken trust. Hold on to that distinction, because it's the whole story. Let me give the bear case a fair hearing because it isn't groundless. The first worry is decelerating growth by region. Split Netflix's revenue into 4 regions. In its largest market, the US and Canada, growth slowed from 15% a year ago to 10%. Europe, the Middle East, and Africa slowed from 18 to 14. Those 2 regions drove the deceleration. Latin America at 21% and Asia Pacific at 16% are still healthy, but the market's eyes locked onto the slowdown in the biggest market. The second worry is a wave of analyst downgrades. According to the research, Pivotal Research cut its target from $96 to $70 and moved its rating from buy all the way down to neutral. Guggenheim cut hardest from 120 to 75. Bank of America went from 125 to 105. The average target is still around $111, above today's price, but every single revision pointed down. So the market's fear boils down to this. Growth is slowing, and the company is trimming the very metric that would let us watch it slow. That's a real concern, which means we now have to look at the other side. Here's the first rebuttal, and it's the one I'd focus on. A slower growth rate and a broken business are 2 completely different things. Netflix's real strength, the wall competitors can't easily climb, is what we call a moat. And Netflix's moat isn't a single gear. It's a wheel that spins faster the more it turns. It's called a flywheel. Follow it around. Subscriptions bring in steady cash every month. That cash goes into content. And here's the key. Content is a fixed cost. Make Squid Game once, and whether 300 million households watch or 400 million, the extra cost is close to zero. So the more subscribers you add, the lower your content cost per person falls. That's the engine pushing margins up. At the same time, the more people watch, the more data piles up. So predicting what will become a hit gets sharper. Hit rates go up, cancellations go down, and that loops right back into more subscriptions. Every turn of the wheel, it spins a little faster. And this isn't just a story. The numbers prove it. According to the research, Netflix's operating margin has climbed from 20.6% in 2023 to 33% today. Return on invested capital, how much the company earns on the money it puts to work, has improved from about 22% in 2021 to roughly 34% now. Its cost of capital is around 9%, so it's earning nearly 4 times what its capital costs. So here's the summary. The speed at which Netflix adds subscribers has slowed, but the company's ability to make money is at an all-time high. The wheel is still spinning, and if that's true, this crash isn't a broken business. It's something else. Now the core idea. Get this, and you can use it on any stock, not just Netflix. A stock price, at its simplest, is fundamentals times an expectations multiple. It's the profit a company earns, multiplied by how many times the market is willing to pay for that future. So when a stock falls, always split the question in two. Did the company get worse? Did earnings shrink? Or did expectations get lower? Did the multiple compress? For Netflix, which is it? As we just saw, revenue, earnings, and margins were all at record highs. Yet the stock fell. So the answer is clear. This crash came entirely from the multiple compressing. We call that derating, when earnings hold steady, but the multiple the market pays comes down. The business didn't leak. The market reset its expectations, and we can reverse engineer exactly what the market is now assuming. According to the research, at today's price, the stock has baked in the assumption that Netflix grows its cash flow by only about 5% a year, forever, less than half the 13 to 14% the company itself is guiding to. In other words, the market is already assuming something far more conservative than management. A pessimistic scenario is largely priced in. Then add one decisive comparison. Look at the operating margins of Netflix's streaming rivals. According to the research, Disney's streaming segment runs around 5.4%, Warner Bros. Discovery around 15%, Spotify around 16%. Netflix is at 33%, it's the runaway leader, and yet, on the multiple, Spotify trades at about 30 times earnings, while Netflix trades at 21.7. The company that makes the most money is trading the cheapest. That's your margin of safety. So the answer to the paradox from the open is right here. The market didn't sell Netflix's business, it sold its expectations of Netflix. And those expectations look badly overshot to the downside. But if we stopped here, the analysis would be only half honest. Even the bull case has a weakness it has to own, and this is the part I want to stress. The future growth engines Netflix is betting on come down to 3, and all 3 are still unproven. First, short form. Netflix is expanding a vertical short video feed. Think TikTok, think YouTube. But the early reaction is a worry. Is Netflix trying to become YouTube? It could dilute the premium content that is its whole advantage. The first hard data on that expansion arrives on August 3rd. Second, advertising. Netflix is building new revenue from a cheaper, ad-supported tier. The question is whether it can hit the scale it's targeting in the US ad market. The third quarter negotiations with advertisers will be the first real signal. And third, the one I watch most closely, the 2030 targets. Back in April of 2025, Netflix laid out a goal, $78 billion in revenue and a 38% operating margin by 2030. But on this quarter's earnings call, management did not reaffirm that goal. Instead, they replaced it with a narrative. 45% of the world's households still aren't customers, and in a $670 billion ad market, Netflix holds just 7%. So they say the runway is enormous. Why does that matter? Because swapping a specific checkable number for a vague, the market is huge, can itself be a signal. In fact, according to the research, Guggenheim flagged the chance that the company lowers the 12% growth rate needed to hit its 2030 goal and cut its target by the largest margin of anyone. So here's the balanced read. The moat is intact, but the next growth engine is unproven, and the market is asking right now to be shown the proof. So, pulling it all together, how should we think about price? I'll use 3 scenarios. But first, let's read the price the market is setting today, backward. At about $69, the stock has baked in, as I mentioned, the assumption that Netflix grows cash flow by only around 5% a year, forever. less than half the company's own guidance of 13 to 14%. In other words, the market has already priced in the bear case. Keep that in mind. Prices are more honest as bands than as single points, and I've set the probabilities from my own view a little differently from the research. Everything is against a current price near $69. Bear case, 27%. The 2030 target is effectively abandoned, the gap with YouTube widens, and the third quarter misses guidance again. Multiple of 18 to 20 times, roughly $71 to $79, call it 75 at the center. And here's the key. The stock is already trading below that bear target. The market is already pricing something worse than the bear case. Base case, 45%. Quarterly guidance normalizes, ad growth holds, and the 2030 target is neither confirmed nor denied. Multiple of 24 to 26 times. $94 to $102, around 98 at the center, about 42% up. Bull case, 28%. Ad negotiations go smoothly. The merger lawsuit I'll get to breaks in Netflix's favor, and the 2030 target gets explicitly reaffirmed. Multiple of 30 to 32 times, $118 to $126, around 122 at the center, about 77% up. Why did I nudge the bear probability down from the report's 30 to 27 and the bull up from 25 to 28? It's simple. The downside is already largely in the price. If the market has bought the bear case, the remaining surprises skew to the upside. But I didn't lean hard bull because of those unproven bets we just walked through. Weight all that by probability, and you land at roughly $94 to $103, with a center near 99, about 43% above today's price. Set a stop around $60, and the reward to risk works out to about 4.4 to 1. So, even the worst scenario sits above today's price, and the market has already bought the pessimism. Limited downside, open upside, an asymmetric setup. Because investing isn't about nailing the exact target, it's about betting the odds. So how do we find out whether this thesis is right or wrong? The good news is the answer comes from data, inside 2026, not from anyone's guess. Let me set 4 checkpoints for you in advance. First, the antitrust lawsuit over the $110 billion merger between Paramount Skydance and Warner Bros. Discovery. If the merger falls apart, competitive pressure on Netflix eases. That's bullish. If Paramount and HBO Max combine, competition intensifies. That's bearish. Second, the U.S. advertiser negotiations during the third quarter. That's the early signal for whether ad revenue is really getting on track. Third, the short-form expansion on August 3rd. Is the becoming YouTube strategy a defense or a self-inflicted wound? The first hard data lands here. And fourth, the most important one, third quarter earnings on October 20th. Does guidance meet expectations, and does growth in the biggest market, the US and Canada, turn back up? Whether the slowdown is temporary or structural gets decided right there. So let's come back to where we started. Netflix. Are you really okay? Here's my read. The moat says it's okay. The company's ability to make money is at an all-time high. The flywheel is still spinning. And this crash looks less like a broken business and more like a derating of expectations. The company that makes the most money is trading the cheapest, and the downside is limited. But the market says, show me the proof. The next growth engines, short form, advertising, and the 2030 target are unproven bets, and management swapping those numbers for a narrative is genuinely worth watching. So this is less a stock you buy today with full conviction and more one you follow, setting your checkpoints and confirming as each piece of data arrives. And that data starts landing on October 20th. I hope this added one more lens for looking at Netflix. As always, this is analysis of a company, not a recommendation to buy or sell anything. The final call is always yours. If it helped, a like and a subscribe go a long way. I'll see you in the next one. Thanks for watching. Cold Open S0. Cold Open /CC01. C04 MP3. Plus tension bed. SFX. S1. S02. S2. S03, S3, S04, S4, S05, S5, S06, S6, S07, S7, S08, S8, S09, S9, S10. Cold open occupies S01, so body scene N, file S, N+1.